Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Welcome to the Stock Play of the Day, Overtime Edition. On Monday's Stock Play of the Day, we talked about FedEx, symbol FDX. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst with Ally Invest. On Monday's noon Eastern Time Stock Play of the Day, we talked about FedEx, symbol FDX. We looked at a long call spread going into earnings on FedEx. So since this was centered around earnings, it was a more speculative trade. And we see the long call spread here in the Ally Invest Options Playbook site. And when we were looking at this trade, we wanted to manage our risk by doing the spread. We wanted to make sure that we had a minimal amount invested in the trade. So the underlying stock, according to the profit and loss graph here, if we're looking at the chart here inside the options playbook, the stock was below both of the strikes. It would have been down in this range, and that lowers the cost because we're using out of the money option contracts. So we bought strike A, hoping that the stock would go above that, and then we sold strike B, mainly because around earnings, we had inflated option prices, and we wanted to use some of the premium from selling strike B to help pay for strike A, and also reducing our risk overall of the trade. So the strike prices that we were using, if I pull up the actual screenshot from Monday's Stock Play of the Day, we were buying the 145 strike, looking to sell, or I'm sorry, the 245 strike, looking to sell the 250 strike. We went out to the September 25th expiration. That meant we had approximately 10 or 11 days before that expiration date. But more importantly, we were focused on the fact that FedEx was going to be announcing earnings on the 15th, which is a Tuesday after the close. So the total risk of this trade would have been $165 plus commission. You always want to think about commission. And as always, we're just trying to learn here on the Stock Play of the Day. So it wasn't meant to be a recommendation. This was just a paper trade overall. So let's go back to the Ally Invest charts here. So here's the Ally Invest live charting platform. And I've highlighted what happened during the trade, during the week, I should say. Now, this is a 5-day chart, and it's, I think it's a 15-minute chart overall. But this was noon on Monday. So this would have been the rest of Monday's trading. This would have been all day Tuesday. They announced earnings, and then this is all day Wednesday, Thursday, and here we are Friday. So as far as the underlying stock, well, there was a little bit of volatility right after the call. It actually came down a little bit, went down to 232. But when we were looking at the trade, I'm looking up here on my screenshot, it was 235.11. So FedEx was trading at $2.35. We tape it live, so it was a live quote. The stock was up $2.32 on the day. Not much activity here, though, going into the trade. Usually, if you're looking at an earnings trade, you probably would have put the trade on somewhere in this time frame, right? Probably at the end of the day on Tuesday, but we taped Stock Play of the Day on Monday, so you look at the quotes on Monday, and that's what you base the paper trade off of. All right, so the underlying stock went up, and here is FedEx. Here are the option chains inside the Ally Invest live trading platform. And we see today the stock is actually down from its highs after earnings. It's trading now at 245.92. Now this is, if we bought the 245, so that is now a little bit in the money, and we sold the 250. Now, ideally, this was based off of earnings. So if I'm doing a trade based off of earnings, I'd want to get out most likely after the earnings announcement, especially if the earnings announcement was good and it was beneficial to me. I probably would have closed the trade on that day. Now, if you hung around, you're still okay on the trade. The trade is profitable at this point in time, but the stock didn't take the momentum from earnings and continue to go on up. and hence making it a no-brainer trade after all. Because now we have a situation where we are profitable, but we're not as profitable as if we would have traded out of this on Wednesday after the earnings announcement after the close on Tuesday. All right, so where's the trade at? When we first put on the trade, my screenshot here says that it was the net debit for the long spread was $1.65 or $165. It's a 5-point wide spread, so the maximum upside would have been $3.35 or $335. Now that would assume that the underlying would close on the expiration date above 250. That's really the only time you're going to really max out on a long call spread. Now, if you wanted to, you could close it out right now. You still would be up. You'd have a decent gain on this underlying, $2.20 if you could fill at the midpoint. And the underlying was at 165. So how would I trade out of this if this happened? If I did that, now we'd have to change this order up. In other words, here's the right rail of the Ally Invest live trading platform. We would have to, instead of buying to close, this would become or buying to open, this would become a sell to close. And then this would become a buy to open. And instead of a net debit to the account, it would be a net credit to the account. And the midpoint is at $2.20. So that's about where we would try to work the order. And so on paper, this is how we would look to exit this trade and just move on and go to the next trade. You got a profit, you're fine. Now, I happened to grab a couple of screenshots because I was watching it after earnings, and I wanted to highlight a couple of things here. First of all, if you did the trade, this was about 10 o'clock on Wednesday. This is when I would consider looking at it and see where the underlying was at. The underlying stock was above 250 at that point in time. So it had blown through our strikes to the upside, which is a good thing overall. The trade that we did right here is the September 25th expiration. Even though it was trading above the 250 level, the maximum of the spread was $3. Now we paid $1.65 for it. And the midpoint right now is right around $3 or $2.98 to be more exact. So we do have a good profit. And at that point in time, I would have thought of just getting out of the trade. You almost doubled your money overall. So just look at closing it out. But I bring the screenshot up because I wanted to highlight that if you did the shorter term expiration, you actually would have made more on the trade. This was the September 18th expiration. I know that the font's kind of small here, but the September 18th expiration, which is today, would have been this Friday. If those option contracts were purchased, you would have paid less up front, and it would have been worth more after that after that big move above 250 after earnings. Why is that? Okay. And as always here on the Stock Play Today, we're just trying to learn. The big difference is that when you are doing a long spread, you're buying one option contract that wants the market to go up, and you're selling one option contract that wants the market to either stay where it's at or go down. So they fight each other a little bit, right? So the best way to make the maximum of a long spread is to actually have all the time premium come out of the short call. So if you're right on your forecast, you would rather have the shorter term expiration. Now, I'll emphasize two things. If I'm right or correct on my forecast, I would rather have the shorter term expiration. Now, if I'm not correct, though, I'd rather be out longer in time. Why? Because then we want our long option contract to have more time value, which means you have more premium and it protects you more. So it's a trade-off. It's a interesting balance to try to figure out. We were doing this around earnings. We gave it a little bit more time just in case our forecast wasn't correct. Then that would give us an opportunity to maybe get out of the trade and salvage something if FedEx would have went down 5 or 6 points as opposed to up that amount. So overall, when we're looking at these two trades on the Stock Play of the Day, always about learning, think about when you're doing long spreads, the time frame that you pick is a very important number overall. It always is with options, but specifically in spreads, because they will max out if you're correct on your forecast closer to that expiration date. And that's going to be it for this episode of the Stock Play of the Day Overtime. My name is Brian Overby, Senior Options Analyst at Ally Invest. Please click subscribe and then ring the bell, and then you'll get all the alerts for the next stock play of the day. See you next Monday.